real pleasure to have you here. Thank you so much. I wanted to introduce John Fitzgerald, the CEO of MGYR Bank. MGYR is one of the more recent mutual thrift conversions, like what Mike was talking about earlier, just past their 1-year anniversary. Stock is selling at a nice discount to tangible book value. You have a buyback authorization in place, and you've already paid a special dividends. Thank you very much for that.
Happy to do it.
Yeah, we appreciate that. We're delighted to have you here talking, and so please go ahead. I don't know if you have if you have slides. If John's gonna.
We do.
If I can help, let me know.
Slide there. I need to share our screen. She wants to share our screen.
Yeah, you can share your screen, or you can. You see that green?
Got it.
Okay.
Sorry about that.
There we go.
All right.
Great, and you can expand that if you want.
There we go.
There we go. Okay, great.
I'm actually going to share time this morning with John Ansari, our CFO. So you're going to see a much better looking guy popping into the screen shortly. We are celebrating our 100th year, Reisner, this year, and we're very happy about that. First, we'll start off with our forward-looking statements, as you see in all of these slideshows, I'm sure. I will say that this whole presentation has been posted on www.magbank.com. So if anyone wants to access it after, you could do that. We were founded, MGYR Bank, in 1922 in New Brunswick, New Jersey. The bank was started due to the fact that Hungarian immigrants couldn't get home loans here. They were being discriminated against. And it turns out that Johnson & Johnson imported a lot of Hungarian immigrants to work in their factories here in New Brunswick. So in I wasn't here, in 1922, they started a bank to make home loans to these people who were being discriminated against. We are on NASDAQ, traded under MGYR. We have 6 branch locations, which are located in some high income areas of New Jersey. And as I said, we're celebrating our 100th year. So we're very happy about that, and more information you could get on that at www.magbank.com. We completed our second step offering July 14th of 2021. We issued 3,910,000 common shares. Net, we raised 37.4 million, and the exchange ratio was 1.2213. These are our locations, again, in very high income areas of central New Jersey. I can add to that, we are, especially with the pandemic, but even prior to the pandemic, via technology, we've really banked the entire state of New Jersey. We try to stay in New Jersey, but we do have some relationships that put us over the border in Pennsylvania and New York. But our market area is definitely the state of New Jersey, and that's where we're at. We have our deposits by branch here, led by our headquarter branch here in New Brunswick, going all the way down to our newest branch, which is the Tano Mall branch in Edison, New Jersey. All of these branches are at break even or plus, and we're very happy for that. I can tell you that we have looked at some other branch locations, nothing really exciting. Our view on branch locations is really their marketing opportunities now more than deposit gathering opportunities. And again, that falls back on the technology piece that I mentioned before. We're able to generate a lot of deposits using various technology means. So branch locations really need to be the right location and the right square footage, meaning we like to have 1,500, 1,800 square foot or less for new branch locations. So I just wanted to mention that. You can see the highlights for us. Last year, our net income rose 6.1 million. That's 179% increase year over year. The first 9 months have gone very well for us. And this is sans PPP fees. We did have a few PPP fees in fiscal year 2022. More of that was in fiscal 2021. So you see we're operating just on a base case at 5.5 million for the first 9 months, which is an increase over fiscal year 21 also. We did issue, as you mentioned before, a special dividend at 12 cents in December, but we have also announced quarterly dividends and paid quarterly dividends for the last 3 quarters. And our plans are to continue to evaluate that as we go on. We announced our share repurchase program July 21st, 2022. It is for 5% of the outstanding shares. We have been slowly executing that. We're looking to ramp that up a little bit, but we are working on that, and we are very interested in that program and need to we understand the value to shareholders. We're shareholders also, so we want to ramp that up a little bit. With that, I'm going to turn it over to John Ansari, our CFO, with some financial highlights for Magyar Bank.
Hello, everyone. Good morning. I get the opportunity to go over the financial highlights with you here. On the first slide here, you can see our total assets have grown at a 6.4% compounded annual growth rate during our most recent 5 fiscal years. During this period, our strategy has focused on moderate organic growth through expansion of our loan portfolio, shown here in blue. We have grown to $791 million at June 2022, and that growth has occurred in loans, which accounts for now 78% of our assets. Our investments in cash, shown here in orange, have grown to 16% of our assets as a result of the COVID-19 pandemic and our customers' preference for liquidity. These assets will help fund the company's loan growth in the future. Here we have the composition and total amount of our loan portfolio. At June 2022, commercial real estate loans accounted for 54% of our loans, followed by 33% in 1 to 4 family residential. These are shown here in red and blue, respectively. The remaining 13% is made up of commercial loans, construction loans, and other consumer loans. The majority of our loans are real estate secured, and as John mentioned, 98% of our real estate loans are located here in our state of New Jersey. We are an SBA preferred lender, which enabled us to immediately participate in the Paycheck Protection Program, or PPP. Our SBA loans are limited to New Jersey and Pennsylvania, and we sell the guaranteed portions of these loans for significant gains. Our non-performing assets are comprised of non-performing loans and other real estate owned, acquired through the foreclosure of real estate collateral. Our non-performing assets were 0.61% of total assets at June 2022. This included 2 delinquent loan relationships totaling $4.6 million and 1 other real estate owned property for $280,000. The other real estate owned properties was under contract as of June 2022, and the 2 loans were in the process of foreclosure. Here we have the composition and total amount of our deposits. Our deposits have grown at a 5.5% compounded annual growth rate, which was largely due to the influx stemming from the COVID-19 pandemic. However, we've been able to hold and grow deposits since then, with total deposits reaching $660 million by June of 2022. This slide shows some greater detail on our checking deposits, which have grown at a 15.6% compounded annual growth rate. Our non-interest checking, which is shown here in teal, reached $180 million at June of 2022, or 27% of our deposits. Combined with our interest-bearing checking, these deposits were funding 35% of our assets. The growth in our checking accounts was partially due to the pandemic and partially due to new customers to the bank, resulting from our participation in the PPP. As a community bank, we were able to quickly respond and assist our business community, resulting in several new large deposit relationships for the bank. Here we have graphed our net interest margin versus our peers and the 10-year treasury rate. Our margin consistently exceeds our peers given our disciplined loan pricing and favorable funding mix. The bank's balance sheet is moderately asset sensitive. We currently hold about $100 million in loans that are tied to prime that adjust either daily or out to 3 months, so very frequently repricing. Our commercial real estate loans are primarily adjusting every 5 years. We have a pool every year that's repricing to higher rates now. And we began offering back-to-back swap rates to our customers about 2 years ago. That is where the bank receives floating, the customer pays fixed, and we swap it back using a correspondent bank. We have almost $30 million of those loans on the balance sheet, which again is greatly benefiting us as rates rise during the current period. So we are well positioned for rising interest rates. As you can see by our June quarter, our margin actually increased to 3.72%. Our net income increased to 6.1 million in 2021. That was in part due to PPP fees. Our PPP fees in 2021 tax affected were about 1.4 million. In 2022, our tax offended PPP fees were about 500,000. So we saw a significant reduction in fees, yet we still had an increase in our net income in 2022, but 22% increase there. And that trend is increasing. If you look at our June quarter, it was up 27% over our June 2021 quarter. So we do see the increasing income there. Next slide has our earnings per share. We made $1.01 per share in 2021, and we're up to 81 cents just for the 9 months ended June of 2022. Our book value per share increased to $14.23 at June 2022. This reflects a 47-cent increase from September of 21, during which period we paid 18 cents in dividends. There are no intangibles in our equity, so this is tangible book value per share that you're seeing here. And that's it for highlights. I'll bring John Fitzgerald back for stock price performance. Thank you.
I get the easy parts. Our stock performance has been very good over the last year. We're up over 16%, and I could add to that. It's a really good time for us to have this buyback program in place. It's still accretive for us because of where we're trading currently, even though we're up, and we're very happy about that, and think we're a very good value with that program. I will add, our strategy is simple. We're not looking to do a lot of things. And actually, even after the capital raise, we haven't added a lot of new product lines, but we have been able to really do well in the commercial real estate market here in New Jersey. We continue in our history, as I mentioned earlier, is in residential lending, and we will continue to have a residential book. We're about 50% commercial. A small portion of that is C&I. We're about 37% residential, including home equity loans. So we're looking to continue that mix, and we'll continue to make residential mortgage loans. Our community banking strategy is what I said earlier. We bank relationships. We're not looking to do transactions or large loan transactions. Even with the capital raise, we could make slightly larger loans than we did before, but we're really focusing on relationships where we get both lending and also deposit relationships involved with that. As John's mentioned, and he does a very good job helping us manage our interest rate risk in this environment. We have a large portion of the portfolio that is based off of prime. All of our, well, let me not say that, 97% of our commercial real estate portfolio is 5-year interest rate adjusted. So every 5 years, that portfolio will adjust. And we're reaping the benefits right now of that as the portfolio is repricing for loans that were made 5 years ago or more. We mentioned IT security and everything that we talk about. It's a really scary area for not only banks, but everybody. We will still stay vigilant in that area and put a lot of resources in that area to make sure that we're safe. We do have an online deposit opening process for retail customers starting in 2022. We will continue to offer technology solutions for our commercial customers. And again, we've really been able to increase our deposit base based off of those products that we've been able to offer, and also not have to look at additional branch locations because of the costs that it would put on our balance or on our income statement. So we don't need to do that. And we will continue, and we have done a good job with focusing on our non-interest expenses. So we will continue that, and year over year, I think you could keep an eye on our financials and see that we've done a very good job with that. And we're always cognizant of that factor. So with that, I know you guys have some questions for us, so go right ahead.
Okay, great. Sorry. If you want to stop screen sharing, you can. Then we can see each other better, but you don't have to.
We're going to do that right now.
Oh, okay. That was great. Thank you so much. We have a question from Ross about how has the purchase of Investors Bank by SBC affected your business? You gaining any more customers, any more lenders?
Short term, no. I think long term it'll have a much better impact on us. I don't think the effects of that transaction have been felt yet here in New Jersey, other than if you're working at Investors Bank. But we do have some feelers out there, and we think we will reap the benefits of that, just as we do usually when larger banks come into our area buying banks, and then there's some dissatisfaction with that customer base from the original bank. So we think we will reap the benefits, but I cannot tell you that we've done any deals so far, but it's coming. I know it's coming because I've seen this act before. So.
Right. Well, it's not a bad thing anyway. It's just
No.
of how good. So you were an MHC, a partially public mutual conversion, along lines of what Mike talked about earlier. Can you talk about? I'm just curious about your decision to do an MHC structure first, and then your decision to go fully public, and what kind of played into that.
Sure. The management team at the time thought it was very important to grow the bank, and they had some numbers in mind that we needed to meet some compliance and regulatory costs. Unfortunately, we did that prior to 2008. It was really ramped up in 2003, 2004, 2005 with some lending products that we probably shouldn't have ramped up at that time. Might have been bad timing, or it might have been bad planning. So unfortunately for us, the initial capital raise was used to weather the storm after the Great Recession, and to manage the bank through, which was part of my job, managing the bank through those periods. And thank God we did, and we've done a pretty good job with that.
Right, and the decision to go to do your second step.
That's really, there was a lot of factors, but one of them was I was getting tired of running a bank that had leverage ratio around 8%. The regulators came out and said they really would like community banks to be closer to 9%. Organically, I'm not sure how we would have gotten there, because we couldn't really grow as quickly as we like, because we didn't have a lot of room to grow the portfolio based off of the capital ratios. So it was twofold. It was regulatory, but then also we reaped the benefits of being able to make some slightly larger loans. Prior to the capital raise, we could make loans up to about $7 million. Now we're closer to $14 million. So we're able to make some slightly larger loans. But when I say that, we're doing that within our customer base and some other known relationships that we've gotten. Actually, we've gotten quite a few great relationships out of PPP. And it kind of goes back to your investor comment. Some of the larger banks here in New Jersey dropped the ball with their customers during PPP. And we were able to pick up a number of really good relationships that led into some good lending relationships out of that.
Okay, well, you've talked about buybacks as looking very attractive right now. Totally agree with that, and the dividend. Appreciate that. We had a question about how you feel about acquisitions, about acquiring other acquisitions, and in the context of your multiple where you're trading on tangible book. Right.
Well, that's kind of, it makes acquisitions difficult. I can tell you that. We will look at things as they come about, but it's not our strategy. And as well banked as New Jersey is, with our size, around 800 million, there's not a lot of attractive companies that we look at that might be up for acquisition. And if they are looking to be, or if they're looking to sell themselves, I think they're pricing themselves at a level that we're not really interested in. And again, it would be dilutive to our book, so it doesn't make sense.
Right. And along those lines, somebody else, as Steve asked, if you've seen M&A discussions in New Jersey pick up at all, and it doesn't sound like it.
No, I just finished my term. I was the chairman of the New Jersey Bankers Association. And I had, unfortunately, a pretty robust M&A market while I was chairman, so we lost a lot of members. And I think it's died down slightly. And I think it will continue based off of what I see out there as far as potential purchasers and potential sellers. So I don't see the activity, at least in the community bank space, as robust as it was over the last couple of years.
Right. Okay. Let's see. And Ed asked if there's any regulatory issues to doing more than your current 5% buyback authorization? For example, can you announce another 5% in short order? And I just wanted to add on to that. I was curious if the new 1% tax on buybacks, I guess in excess of $1 million value, if it has any impact at all.
You know what? It does have an impact on our current buyback. I just say that, but it wouldn't preclude us from doing another buyback. And we realize the value to shareholders with that buyback. We realize the value of the franchise with those buybacks. So it wouldn't preclude us from doing another, but we need to execute this first 5%. We will continue those discussions at the board level, but we really need to ramp up our buyback right now. So.
Right, I agree with that. And also you pay almost a 1% dividend. And so that would be 1%. You wouldn't be paying a dividend on those shares you repurchase. So it kind of offsets the tax there. Ed had another question. He asked.
In theory it does, but it's still a tax, which hurts.
That's true. I guess that's true. Yeah. Ed had another question about if there's any blackout periods that you'd have to deal with around the buyback, or do you have a 10b5 authorization plan?
We have a plan in place that we could buy during the blackout, and we're coming into we're 9/30 fiscal year end. So we are coming up to a buyback or a blackout period, excuse me.
Right.
So we needed to have that in place in order to continue to purchase shares.
Okay. Okay, that makes sense. And somebody asked about how you feel about credit. What's your outlook on credit, and are you seeing any signs of stress in any loan categories? Collateral values?
Collateral values, not yet in New Jersey, but it's coming. So we're being diligent with our credit standards here. We're seeing what we think is some unreasonable competition, not only from banks, but from other entities that are coming into the lending space, especially in the multifamily area. We're trying to avoid that. Office, we take a very hard look at as far as financing that here in New Jersey. But some other areas are red hot in New Jersey. Industrial, warehouse, some of the owner occupied spaces that we see are going very well in the commercial real estate market. So we're trying not to lower our credit standards at all. Again, as I mentioned before, we're trying to stick to that 5-year rate adjustments on our commercial real estate paper, unlike some of the competition that we're seeing. And again, some of the customers don't like that, but if they get a good deal somewhere else and they're locking in for 10 years at a rate that we think is unreasonable, we say, God bless you, take it. We can't help you out here. So we got to stick to our standards here, because I don't want to live through another cycle like 2008. Not that this is going to happen now, but I just, that experience was enough to make sure that we stick to our guns as far as credit standards.
Right, it definitely was a learning experience for us all, definitely. You have a wonderful, a very strong deposit franchise. Like you mentioned, 27% interest-free deposits. You also mentioned in the prospectus some of those deposits are muni deposits. I think about a year ago, at the time of the prospectus, it was around 20% of the deposit base was in muni type deposits. Can you just describe those type of deposits, give the complexion of them, such as how relationship based are they, and are they in the non-interest bearing? Are they more in the money market or CD category? Are they kind of cash management type accounts?
They're not cash management or CDs. They're all relationship driven. They're all local. We have some very good relationships here with some of the municipalities and boards of ed. And in New Jersey, we have a lot of authorities that do various types of business here in New Jersey. They're public entities that fall under our CUPA rules here in New Jersey. So we're very, we think we have solid relationships. They're not going anywhere. But you mentioned non-interest bearing, and they are non-interest bearing currently, but we're feeling some push as far as to look at some interest bearing products for those customers, and which we will do because they have been loyal customers for a long time. And like I said, I could look out the window here and see some of their buildings. So I will, we'll make sure we take care of our local customers. We try not to take on a lot of GUPA business. We could have. In New Jersey, there's some rules that make it very difficult when you bank government entities as far as collateral that we have to post. And at the time, the collateral was yielding very little. So we did have opportunities probably for another 200 to $300 million in deposits that we said we took passes on at various times, but we could always revisit that if we need to.
And I'm just one more question to follow on the muni deposits. Are they something that you have to kind of renegotiate annually, or are they more longer term?
They have been longer term. We've
Okay.
the relationships we've had are 15 to 20 years
Oh.
relationships. So we've done very well with that.
Okay, yes, this goes way back. Okay, great. And wanted to ask about the loan growth, because you've had some very strong loan growth. And it sounds like it's coming largely from new customers through the PPP program, but also through existing customers through increasing the size of the loan relationship that you can offer them. Doesn't sound like much market share from consolidation yet. That's a potential, but maybe you could just talk about the drivers for loan growth that you see.
Sure, and I think that is coming from consolidation. I think we'll get some. We've also added a lender, and we're continuing to look for lending talent, but it has to be the right talent. Haven't been in this area for 35 years in community banking. We know, I know, and people around the bank know a lot of people in the business. So we want to make sure we have the right people here with the right mentality. We are very happy that the $56 million of PPP loans that are no longer here at the bank have been replaced with commercial real estate loans.
Okay.
For the most part. A little bit on the residential side, but we've been able to replace that book. And again, it's sticking to our standards, and we've been getting decent rates on those. We actually specialize in loans 3 million and under. What we found was a lot of banks didn't want to play in that area, but we're fine with that. Making a $500 million or $500,000, excuse me, loan to a small commercial real estate project here with a known entity, typically a customer that we already have that's looking to buy another building or another property. So we're very happy in doing that also.
Okay, sounds good. We just have two real quick questions from Howard about just back to the muni deposits. What's the average rate on those deposits? Approximately.
Hold on, you got me on that one.
That's okay. And then
No. Yeah, probably 50 basis points.
about 50 basis points,
yeah,
right? And you mentioned earlier that you're looking to potentially walk that up some because municipalities have a fiduciary duty to
Absolutely.
get the highest rate, but you said it doesn't come up for renewal, necessarily every year. It's a relationship.
It hasn't, right? It's
They
been a
do have
relationship.
Right. Okay. All right. Very good. Well, we really appreciate you. Thank you, John, so much, and your team. We really appreciate you coming, and it was great to meet you.
Thank you for the opportunity. We appreciate it.
Thank you.
Thank
Appreciate
you.
your time.